Hi, I'm Sterling Shea with Barron's, and I'd like to welcome you back to the second in our series, Let's Talk, a conversation on the future of wealth and asset management. I've got three people here with us today who have a lot of opinion and conviction about that topic. I'd like to welcome Joe Duran of United Capital, Valerie Newell of Riverpoint Capital, and Dr. David Kelly of JP Morgan Asset Management. Investment performance is certainly a function of outcomes, but yet they're different. And I wonder how the American investing public views that difference. Do they understand it?
Investment return is only one aspect of outcomes. Outcomes is also on spending. Outcomes is how much risk you feel comfortable with. Outcomes can be, is your estate plan updated? Do you have the right insurance? So it's a much broader way of looking at your financial life. Are you spending too much? Are you spending enough?
Investing and outcome advice is basically saying, look, there are certain things you have absolute control over. That's where we need to spend 90% of our time.
Part of the story is just focusing on the basic investing principles. I think a lot of it is life principles too. You've got to decide, how long you're going to work, how much you're going to spend, how much you're going to save. That's the first choice you get to make. But even when it comes to investing, you've got to separate out from what you instinctively want from what you actually need. And I think that's a really important first step to getting to better outcomes.
The reality is every single plan that has ever been written is wrong. And I say to people, well, I've got a plan built. And I'm like, well, the plan, of course, is wrong because there's two assumptions that we know are incorrect. First is that you will lead an average life. And every lifetime is filled with once-in-a-lifetime events. So the number one thing any advisor does for their client is to help them course correct. Because as life unfolds and they lose their job, or they inherit some money, they get divorced, someone gets diagnosed with cancer, those things completely affect. And that is where most advisors should spend their lives because those decisions and how we react and how you make choices then affect everything.
And so you have to manage around these other parts of their lives, spending, saving, insuring, all this other stuff to make sure that they're going to get to their outcome.
Going back to the principles of why you work and what you want money to do, we try to remind people money is fuel. It helps you to remind yourself money is fuel, and no more than you go on vacation, you wouldn't go to a gas station. You want to make sure there's some gas stations along the way. Money is fuel, and so it's very helpful when you're having these conversations, say, what do you intend it to do? What things do you want to know you won't suffer? What things do you want to make sure you'd absolutely accomplish?
Are advisors in the current market doing enough to educate their clients on risk?
Sometimes. I think we are moving more towards a consultative advisory kind of environment, and that's good. And I hope that a large part of that conversation is about, very much about how you as an individual should invest, but also I think people need to be a little bit more strategic, both in terms of overall asset allocation and then within asset classes, looking at where to overweight, where to underweight in order to do better, and what I think will in fact be a more challenging environment in the next few years.
I think it comes down to education. When we have a client that is very concerned, or in the other way, what we do is we sit down with them and talk to them about the market, about the details of the market, the fundamentals of the market. What are earnings doing? What's the economic growth doing? What's the job market doing? So that they can ground themselves in actually what's going on.
One of the subsets of the government making money so available is it's pushed everybody out the risk curve. And it has worked. So it just tells everyone you should take even more risk. And it's hard to identify an area where you don't have a fully priced reflection of a very optimistic outcome.
I think the first thing is just recognize that risk is real. And it didn't become any smaller just because you haven't experienced a bad outcome recently. It's still very real, very tangible. And so you just have to be disciplined enough to accept lower returns and to particularly be careful about buying into the most sort of exuberant parts of both fixed income and equity markets.
It's important to point out to people, when valuations are stretched, the possibility of a surprise that causes a fairly meaningful correction grows exponentially. Absolutely. Because you're priced in for perfection. And I always try to tell people, look, the market is a reflection of everyone's current opinion of the future.
It's very important for people to be balanced because one of the things that over the years, as people have perceived risk, the antidote to risk was just having more and more fixed income in a portfolio. The problem is that after 37 years of a bull market in bonds, bonds aren't offering quite as much protection against a sell-off in the equity market, but they're also limiting returns.
Is it more likely for investors to make mistakes in this kind of environment?
Investing is always a trade-off between greed and fear.
And that's what's led to these huge cumulative returns. But it has been moving up slowly. But Joe, to your point, the idea of valuations being high, being risky, I think is really important. I mean, I often say to people, you can't hurt yourself jumping out of a basement window.
And most people understand that timing is not possible, but the media keeps acting like timing is possible.
Absolutely.
It's a problem. Using a risk assessment vehicle or questionnaire is something that's really, really worked for us.
The risk question is an interesting one because the way we see it, people make very rational decisions when presented with risk in a non-risk environment.
So you also have to remind people that risk is simply not an extrapolation of recent volatility.
The time to talk about an earthquake is when you haven't had one for decades. Unfortunately, most people want to talk about earthquake insurance after the earthquake.
I mean, in most aspects of life, emotions are a wonderful thing. Investing, they are an absolute curse. Because when do people want to get in? They want to get in when they feel comfortable. And when they want to get out, they want to get out when they feel uncomfortable. But when do they feel comfortable? When markets are high. When do they feel uncomfortable? When markets are low. It is an exact recipe for buying high and selling low.
What we're trying to do is identify what natural instincts do they have that might cause them to destruct. We use behavioral economics, so we have a psychographic system we use where just by answering 7 questions, we can tell if they're driven by fear or happiness or commitment. And fear-focused people will be, no matter what they tell you in any risk profile, much more concerned up and down than they would if they were a happiness-focused person. So interestingly enough, I think this is an area where there's been a lot of growth, very little application. But to me, it's fascinating to just help people understand, look, our challenge is not the thinking part of you, because all humans make the right decision if they're conscious, if they're calm, and have the facts in front of them. The problem is that almost every tough decision will be with unknown outcomes, with a big decision that needs to be made. And those times, your emotions are going to be in the middle. Again, one of the problems with do-it-yourself investing is who's going to help you make the right decision when your emotions are on fire?
What percentage of your fee do you justify in simply keeping your clients from doing something dumb?
Yeah, a lot.
Well, for us, we think at least half of what we do is not access to a portfolio, but helping you understand yourself.
Mm-hmm.
You don't just own one stock, or you're not just invested for one day. You've got to get people to understand you own this vast portfolio. What we're talking about here is the whole forest, not one tree. The less somebody knows about a subject, the more likely they are to get scared about it.
You will find people's reactions to dollars quite different than percentages. They're willing to sit through a 20% decline, but don't have my 5 million become 4 million.
No, that's right.
A dollar is emotional, a percentage is not.
My big tip for average investors is to stay diversified, because it's so easy for people not to do that and to be evaluating where they look for opportunities in the market, but don't get too unbalanced. I mean, it sounds pretty simple for us, but people don't do it. And so that's one of the things that when we look at a portfolio, we have to rejigger it because people have not done that.
I've sort of lived through and worked through both bubbles and busts in markets. And what always happens at both extremes is that people want to ditch some part of the portfolio that did them harm.
I'd underline that absolutely, that the natural inclination for people is to sell their losers. And in fact, in a diversified portfolio, those are the things that are doing exactly what they should be doing, which is not behaving like everything else, which means that when your favorite investment starts to go bad, hopefully what you didn't love is now becomes your new favorite.
Some program of rebalancing or some discipline about rebalancing is really important, because what's going to happen is not only you say you don't want to sell the losers, but the truth is the losers will actually become smaller in a portfolio.
Exactly.
As markets get higher and higher in value, is that there will be plenty of people whispering in the ear of investors saying, I can't believe you're doing this boring old discipline thing, or you ought to be investing in this exotic product or that one, because you can get 10%, 15%. Some people say you might make 25% or whatever. And it's very important to be able to pull people back from that and say, I could have done that too. I'm not doing that. I know you would like, it'd be nice to talk about the one magic bullet here, but it doesn't exist. In fact, a very old saying in economics, there is no free lunch. That you can take advantage to some extent of the prejudices of other people and problems in the market and mispricing in the market, but those require a very cold-blooded, disciplined approach to investing. It's not simply buying the thing that's gone up the most recently. That's usually a recipe for disaster.
As it gets to the discussion about building better and more durable portfolios and the inhibitors for advisors doing that, would you speculate why, for example, there isn't more money invested currently outside of U.S. markets?
Yes, I mean, this has been an issue for a long time, what we call home bias in the investment management business. People like to invest in what they're most familiar with. But what we see is, looking overseas, the global economy is actually growing fast in the United States right now, and there are plenty of opportunities overseas.
The synchronization of global growth right now is pretty exciting.
I think one of the problems we particularly have in America, and this is less of a problem elsewhere, is that Americans get a very narrow and filtered view of the world. We have this idea that there's chaos elsewhere in the world, when in fact, most of the best money is made in boring places. And there is a lot of opportunity overseas. So I think, again, we have to constantly fight against it, remind people that, in fact, there are plenty of opportunities overseas.
Be an objective champion for the consumer, identifying areas that they should be invested in, that they by themselves might not see.
We've got to remind people that, what you want to do is diversify away from your stream of income, not concentrate your wealth and your income in the same place. If you even think about your total assets, and I think Joe, you're talking about looking at the total picture. If you have a house in Michigan and you work for an auto company and you own auto stock, you've got 3 levels of exposure.
Crazy. But David, if you talk to a client about that, that really means something to them, and they appreciate when you point that out. So it's not something that they really thought about. Advisors need to be well-trained. They need to be experts. I tell the young people in our firm all the time, if you don't have the right answer and you're giving people the wrong advice, you can ruin lives in this business. And so I think that it's technical competence, really being an expert, and also always really connecting with your client.
The human advisor will win if they understand their clients better than anyone else. That's the bottom line.
One way that I think you can get people to be more longer term in the equity market is if you set up a bucket strategy for them. So what we do is we'll put the liquidity needs in one bucket with very, very short-term bonds or money market funds. And then the intermediate bucket will be maybe bonds 3 to 5 years, and that will be 3 to 5 years of their liquidity needs. And then you put in the third bucket, the longer-term bucket, your equities, your growth assets, so that if you discuss with a client, here's what this is for, here's what this is for, here's what this is for, they have a lot easier time being patient with the ups and downs of the market.
And then when the markets do well, you replenish from the long term and replenish maybe a couple extra years. So right now it would be, instead of having 5 years, let's make sure we have 8 years, because the markets might not be that great. It is a very powerful way for individuals to just make the right decisions.
And one of the things I think that happens in our industry is that advisors will not have those kind of tough discussions with clients. It's just easier not to. It's easier just to, have these surfacey discussions about the investments. It's the complacency, I know.
And some advisors are too afraid to be the arbiters of truth because the guy down the street is telling them they don't need to worry about it. They've got plenty of money. They'll be fine.
When I visit my doctor for the annual checkup, he always takes the time, and I really love him for this, to really talk through the various little things, thankfully little, that I have to talk to him about. But he tries to explain it in a language that I understand, and that makes me a partner in my own health. And that actually means that when he's not looking over my shoulder, I can actually make some better decisions or know when I've got a problem or when I don't have a problem. But it's very important, rather than the idea of simply prescribing something or saying, oh, this is what you got wrong with you. To explain his thought process so that I'm part of the decision. I feel like financial services and investing is just the same thing. We'll have better investors if we have better educated investors.
It's tough to get clients to really buy into something that they're confused by, because it goes into this whole thing about Wall Street, and that they try to sell you things that you don't understand and that maybe not be in your best interest.
Well, I think that's right. I think you have to always work on making sure that what you're talking about is understood by the client. Most of the important things are absolutely understandable.
You made that point about trust and the intellectual trust that helps an advisor coach decisions that need to be made about the investment mix.
We spend so much time counseling our clients, being partners with them in their financial decisions. So you really know somebody trusts you when they don't do anything without consulting with you. And it's a really great feeling when you have that kind of relationship.
Our industry tends to really focus on the people in the relationship who deal with the math. And interestingly enough, the person who's not included typically has the most frustration at not being heard or not being listened to. Unfortunately, for many people, that's the woman in the relationship, even if she's the primary breadwinner, who doesn't get to be heard or have a loud enough voice. For us, it's a big deal to make sure both sides of the party, and sometimes it's the male who's the non-CFO in the family, but no matter who it is, you're both sharing a life. It's important that you both understand the trade-offs and compromises you're going to have to make, and agree to them and understand them.
We spend a lot of time talking about how do you talk about the big picture with an investor. And it's not just because we're actually interested, although we are, in interest rates and economic growth and what's going on in China. But having that conversation back and forth with an investor, from an advisor to investor and back, having that conversation about the big picture builds a sort of bridge of intellectual trust.
Understand the life you want, making sure you're protected from bad outcomes, making sure that you react the right way, because every investor in this world really wants to invest so that they can live the life they want. Now, the only question any investor ever has when they call concerned is, am I okay? It's the only question they have. Am I all right? And that basically means we have to know the life they want. We have to make sure they have the resources to live it. And if they don't, let them know what changes they need to make. And they need to be protected from nice surprises. We have a different level of complexity. While there's a lot of interesting alternatives in ETFs, there are now so many choices, it's very hard to filter through what makes sense, what doesn't. When should you have a mutual fund? Because now there's the misnomer that ETFs are cheap, mutual funds are expensive. Well, that's not actually true. It depends on what you're investing in. And so our job as advisors is to help educate the client in ways they can understand, because again, they don't want to spend their lives on this stuff. I think we are facing one of the most difficult periods for any retiree, any person approaching retirement ever in history. They're on their own. And if you look at what's happened to almost every institution, every pension plan, they are underfunded. That crisis is now happening for individuals because they actually have a longer time frame than they think that they're going to be around. They are putting plan assumptions that are too optimistic, and therefore, and I always say to people, we need to get to this as soon as possible, because time is the one commodity that is certain to pass and which you cannot recover. So the sooner that we sit down and stare at your plan assumptions and treat human beings and their financial lives much like pension plans used to treat the entire plan, and say, is your plan currently adequately funded for everything we know today and reasonable assumptions about the future? They don't realize, hey, $2 million isn't what it used to be. If it doesn't grow by 10% a year, which a balanced portfolio might struggle to do when fixed income's at 2 or 3, then what happens? What happens after taxes? And what happens if you're around for 30 years in retirement or 40 years in retirement?
just stretching your work for a few more years into retirement, you're contributing more to your various 401k and other retirement vehicles, and at the same time you're shortening the length of time that money is going to have to look after you. So it is an adjustment you can make before you retire. Once you've retired, of course, it's much harder to get back onto that income train, and I think that's why it's important to think about these things before you hit retirement.
Well, so that's one of the most important things we can do, and good advisors do, is talk about what the right expectations are, what the right capital markets assumptions are, and how does that really work in an actual portfolio, in an investment plan, and in a life plan.
How are you framing that conversation now?
Well, a lot of it is talking about exactly what do we expect given modest investment expectations, capital market expectations, and helping clients figure out, okay, how can you safely live the rest of your life?
You know, people very quickly realize, especially when they make the transition, if they haven't thought about what they want the next phase to look like, it's very, very hard for people. It's the one thing we notice the most is that they'll reach the finish line and then they'll say, you know, I never really spent enough time thinking about what I'm going to fill my days with. Golf costs a lot, travel costs a lot, eating out costs a lot, visiting the kids costs a lot. And all of a sudden you're going, wow, I thought I could live on X and it turns out to be 2X. I really should have worked longer. I should have had a consulting engagement. The interesting thing is I think a lot of people are approaching retirement with a very different perspective now than they used to. But for us, like with Valerie's clients, we find very much that you want to talk about what are the things you absolutely don't want to experience.
Yes, I think that sometimes people don't do a very good job of really understanding what their clients' expectations are and then making sure that they are reasonable and pushing back on that. And if you work with clients that have good expectations, or you can help correct those expectations, that's when you're going to get a good outcome for them.
And one of the things that I can tell you is most universal is, I don't want to be a burden to my family. Right. It is, across our 20,000 clients, the most frequent thing we hear is, I don't want to be a burden to my family.
Well, I think that gives good opinion and context around the relationship and differences between outcomes, performance, and risk. Joe, Valerie, David, thank you very much. Let's keep talking.